Hey traders, are you reading candlestick charts correctly? That's a question you have to ask yourself, and it could be directly contributing to your ability to profitably trade in any market. So in today's video, we're going to be talking about the anatomy of a candlestick, and later on in the video, we'll even be diving into how these candlestick charts can help us to determine and predict market direction. So if that all sounds interesting to you, then make sure to click that like button. Alright traders, so we're going to go ahead and quickly go over the anatomy of the candlestick, and then directly after that we'll talk more about what it actually represents and how we can use these candlestick charts to determine market direction. So let's go ahead and talk about the candlestick that you see on your screen. Each candlestick is going to have 4 main points. Your main points are going to be the open of the candle, the close of the candle, the high of the candle, and the low of the candle. The open and close will be determined by the top and the bottom of the actual body of the candlestick. The body of the candlestick is this green area you see here, and green represents a bullish candle, or a candle that closed above where it opened. So this candle had a starting point, and as soon as the hour, day, or weekly candlestick that you're looking at started, as soon as that candle starts, that is considered the open. And we'll talk more about time frames in just a second, but that's considered the open of the candle. Now what happens after the open is shown by the shadows or the wicks, which are these black lines here, and by the close of the candle. The shadows in the wicks represent where price action went. So in this case, we would have had a candle that started here at the open, pushed down to the low, then back up, and then past our close to the high of the candle, creating that wick, and then back down and closing at the end of whatever time frame you're looking at to create the close of the candlestick. So for this example, let's pretend that this is a daily chart. So the beginning of the day, this market would have opened here at the open. Price action would have moved down to the low, up to the high, and then back down at the end of the day to close right here at our close. And this is an example of the anatomy of a bullish candlestick. Now we'll quickly go over a bearish candlestick as well. Now as you may have noticed, these two are very similar. The only difference in a red or bearish candlestick is the fact that the close was below the open. So here we have the open, and again we'll use this as a daily candle just for example purposes. So the beginning of the day we have an open here, and this candle would have opened there, pushed up to a high of the candlestick, pushed all the way down to the low, creating that bottom wick, and then closed at the end of the day right at our close. And since we have a close that is below our open, then this candle represents a bearish day. So that time frame was a daily time frame, so that would represent a day where markets fell off, a day where markets closed below where they opened, and that would represent weakness in a market. So that was a quick run through of the anatomy of a candlestick. Again, the high represents the highest point price action got during this specific time frame. For this example, we were using a daily time frame, so this would be the highest point the market got to in that daily time period after the open, which was here, and this would be the lowest point price action got during that daily time period until it pushed back up and came here for the close. For a bearish candle, the close will always be below the open or on the bottom of the body of the candle, and for a bullish candle, the close will always be on top of the body or above the open of the candle. Alright, so now that we've quickly been over the anatomy of a candlestick, let's jump into what these candlesticks actually represent. And then later on, we'll discuss how we can use candlestick charts to predict market direction. Alright guys, so let's dive into what these candlesticks actually represent. Well, each one of these candlesticks represents a specific time period. If I click over here on time periods, you can see that we have time periods ranging from 1 minute all the way to 1 month. So with that being the case, if we were to click the 1 minute chart, then each candlestick would represent 1 minute or 60 seconds of price action. We would have the open of a candlestick every 60 seconds on that 1 minute candlestick chart. We would have price fluctuating within those 60 seconds down to the low, up to the high, and then we would also have a close of a candle every 60 seconds. So each one of these candlesticks would represent 60 seconds on a 1 minute chart. And if we were on a 1 month chart, if we go all the way to the other end of the spectrum, then the same rules apply. If we were on a 1 month chart, if we were to click this 1 month chart here, then each candlestick on that chart would represent 4 weeks of price action. We would have an open at the beginning of the 4 weeks. We would have price action in between the 4 weeks going to the low and the high of the wick or the shadows of the candles, and that's what would represent where price action's been. And then we would have a close of the candle at the end of 4 weeks. All of this is represented by one candlestick depending on the time frame you're on. So currently we're on a 1 week chart. That means that when we scroll down the chart here, each one of these candlesticks represent a full week of price action. For the green candlesticks, we have a full week of price action that started at the open or the bottom of the green candle. We have price action in between represented by these wicks coming down to the low and moving up to the high. And then at the end of the week, we have the close of the candle. So that represents a bullish week in price action for our current pair. Currently, we are on the pound Aussie. So for this pair, during this full week of price action, we had a bullish week represented by this candle. Now the same thing applies for a bearish week, and I'll go through that really quickly. So for this case, we have an open. At the top of the body is where this market opened. We have where price has been represented by the wicks, the high and the low of the red candle, and the close of the candle at the end of the week at the bottom of that body. So that would represent a bearish week of price action. And again, guys, these same rules apply no matter what time frame we're on, and this can go anywhere from a 1 minute chart all the way up to a 1 month chart. So each one of these candlesticks represents a certain period of time. And once we start putting these candlesticks together, it's when we can start determining market direction based on candlestick charts. So that's what we're going to dive into now. So combining all of these candlesticks together is how we can start to actually determine market direction and determine trend, and also determine structure levels such as support and resistance. And these are going to all be foundational parts of success in any trading career on any market. Understanding how to read a candlestick chart is the foundation of any good trading strategy. Alright, so we have a starting point down here, correct? This market pushed up from this level with a nice impulsive move, indicating a lot of buyers coming in from that direction. Now, what we're looking for next is to see if that level is broken. So we have a high. And when I say high this time, I'm not talking about the high of a single candlestick. I'm talking about the high that's represented by the combination of candlesticks throughout this impulsive move up, which was right here. The high is what's created before the pullback. So this pullback represents people selling from the market. A combination of people selling, and the reason they're selling can be because of many different factors. Some people that were in down here at this level that we started from are now just taking profit. Other people may be jumping in based on some type of fundamental news release or based on some type of technical analysis. But all of that is really irrelevant information, because all we want to do is look at the chart and understand what it's doing. So once we've created that high, we're looking for a pullback and then the creation of a new high. This 3-point move is how we can start to determine market direction. Once we have this 3-point move, a low to a high, to a pullback or higher low, to a new high, once that's created, then we can determine that the market direction is currently up. The market direction is bullish. And with that being the case, we have the ability to restrict ourselves to only bullish trades, to only long trades, and this can really be beneficial to a trading strategy. Now, what are we looking for after this 3-point move? And this is where a lot of traders get confused. Well, we're looking for this uptrend to continue before the break of our support level. This is our support level. So before this support level gets broken, we expect the market to come up and break above this resistance level and continue our uptrend. And that's exactly what we get. Here we have this pullback again, selling pressure from taking profit, from traders taking positions based on fundamental news events and traders taking positions based on technical analysis. And then we have another push up, continuing our uptrend because we've now broken above our previous high. And since we have a break above our previous high into a new high, what are we expecting? We're expecting another new high, and we're expecting it before the break of this support level right here. Now, some main places that we can expect this market to turn around while in this uptrend are our previous points of resistance, which would be represented by this and this. That's a spot where the market is likely to continue its trend to the upside, or we could look at other support and resistance levels through this zone as likely zones for the market to continue its trend. Other examples of that would be right in here, because that level has acted as resistance before.